Warren Buffett is one of the richest men in the world, with a net worth of over $100 billion. But did you know that he didn't always know how to make smart investments? In fact, some of the best financial advice he received changed the entire course of his career. If you could get inside the mind of one of the greatest investors of all time, what would you learn? This article will uncover the financial advice that changed Buffett's life and helped him build his fortune. You'll discover how patience, risk management, and understanding the true value of a company are all part of Buffett's genius strategy. Plus, we'll share surprising facts, statistics, and quotes from Buffett's own experiences that reveal the simple truths behind his success. So, let's dive in and learn the secrets of one of the most successful investors in history. Chapter 1. The Oracle's Awakening. The advice that sparked a revolution. Warren Buffett, often called the Oracle of Omaha, didn't always know the path to wealth. In fact, it took a pivotal piece of advice to set him on his course to success. It was in the 1950s when he met Benjamin Graham, his mentor, and the father of value investing. Graham's key insight, price is what you pay, value is what you get, changed Buffett's entire outlook on investing. Before that, Buffett had a typical approach to the market, buying stocks based on short-term trends and predictions. But Graham's philosophy was different. Focus on long-term investments in undervalued companies. Graham's words stayed with Buffett, and he began to look for investments that had intrinsic value but were priced lower than their true worth. This is how the concept of value investing was born. Buffett once said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This quote highlights the core principle of his strategy: finding companies that are undervalued based on solid fundamentals, not just their stock prices. Buffett took this advice to heart, buying companies that were ignored by others because they didn't seem flashy or glamorous. For example, he bought shares of American Express in the 1960s when the company was struggling due to a scandal. At the time, few saw the potential. But Buffett did. He saw value, and that's why he bought in. In many ways, Buffett's big breakthrough came when he learned to ignore market noise. He doesn't believe in trying to time the market, unlike many investors. Instead, he focuses on long-term stability. In the business world, the rearview mirror is always clearer than the windshield, Buffett once said. This means that past performance is a better indicator of future success than any predictions or trends. Today, his approach is simple but powerful. He looks for companies with strong management, a solid track record, and consistent earnings. He doesn't try to predict the next big thing. He just invests in companies that are consistently good at what they do. It's about quality over hype. The advice that changed his life wasn't just about picking stocks. It was about thinking long-term, about patience, and about not being swayed by short-term volatility. It's the foundation of his legendary success. Chapter 2. The Power of Patience. Why timing is everything. One of the most powerful lessons Warren Buffett learned was the importance of patience. Buffett's approach isn't about buying stocks quickly and selling them for a fast profit. It's about waiting for the right opportunities. His investment philosophy is all about looking for the perfect match, a company that fits his criteria, and holding onto it for the long haul. In fact, Buffett has often been quoted saying, "The stock market is a device for transferring money from the impatient to the patient." He understands that the best investment opportunities take time to unfold. This patience has allowed him to make significant gains that many short-term investors miss out on. But why is patience so important in investing? The answer lies in the concept of compound growth. Buffett is famous for saying, "Our favorite holding period is forever." By patiently holding onto his investments, he allows them to grow over time, benefiting from the magic of compounding. For example, his investment in Coca-Cola in 1988 is a perfect illustration. Even though the company was already well established, Buffett saw its long-term potential, holding onto it for decades. Buffett's patience allows him to ignore daily market fluctuations and focus on the long-term trajectory of the businesses he invests in. Research shows that the longer you hold an investment, the less likely it is that short-term market swings will affect its value. This principle of long-term thinking has served Buffett well, earning him an annualized return of over 20% since the 1960s. In fact, studies show that most individual investors fail because they try to beat the market with short-term trades. According to a report by Dalbar, the average investor's return over a 20-year period was only 4.67%, far below the S&P 500's return of 7.68%. The difference? Patience. While the market's ups and downs can make others panic, Buffett stays calm and waits for his investments to grow. Many investors are lured by the thrill of quick profits. But Buffett's wisdom teaches us that slow and steady wins the race. It's about waiting for opportunities, being prepared, and sticking to a strategy without being distracted by market noise. Chapter 3. Risk isn't what you think. Buffett's unique approach to safety. Warren Buffett's view on risk is one of the most unique aspects of his investing strategy. Unlike most investors, who see risk as the potential for loss, Buffett views risk as the possibility of losing your investment because you don't understand it. This is a subtle but crucial difference. He often says, risk comes from not knowing what you're doing. In other words, if you thoroughly understand an investment, the risk is much lower, even if it seems risky to others. Buffett's definition of risk is grounded in knowledge. He believes that if you know the company you're investing in, its products, its management, its finances, then you're less likely to make bad decisions. For example, his investment in See's Candies in the 1970s was seen as risky by some. But Buffett understood the company's strong brand, loyal customer base, and consistent profitability. He didn't just see the price of the stock, he saw the value and stability behind it. A fascinating statistic backs this up. According to a study by Credit Suisse, the top 1% of investors earn around 20% higher returns than the average investor due to their ability to minimize risk. But it's not about avoiding all risk, it's about reducing risk through knowledge and understanding. Buffett's strategy also involves a deep commitment to what he calls the circle of competence. He only invests in industries and companies he understands. That's why, for example, he avoided investing in tech stocks for so long. He admitted that he didn't fully understand the complexities of the tech industry, and therefore, he saw it as too risky. His advice is simple: stick to what you know. This approach has helped him avoid many of the pitfalls that trip up other investors. While others may chase the latest trends, Buffett stays grounded in his core areas of competence. And this discipline has paid off tremendously. It's also why he emphasizes the importance of investing in companies with strong management and a proven track record. For Buffett, risk is not just about volatility, it's about making informed decisions based on solid understanding. And when you focus on what you know, you can make smarter, safer investments that pay off in the long run. If you're finding these insights valuable, don't forget to subscribe for more strategies that can help you make smarter investment decisions. Chapter 4. The Circle of Competence, a strategy to maximize your edge. One of Warren Buffett's key strategies is understanding his circle of competence. This means that instead of spreading himself thin by trying to invest in every industry, he focuses on what he knows best. Buffett once said, "You don't have to be a genius, you just have to be within your circle of competence." By sticking to his strengths, he can make better decisions and avoid unnecessary risks. Buffett's circle isn't about knowing everything, it's about knowing a few things very well. For example, he knows the insurance industry, the consumer goods market, and the fundamentals of businesses that can generate stable cash flow. This narrow focus has helped him spot value that others may overlook. By staying in his lane, Buffett has been able to build a portfolio that continues to perform well over the long term. Research supports this idea. A study from the CFA Institute found that successful investors tend to stick with industries they understand, rather than chasing every trend. Buffett's success story shows that expertise in a specific area can lead to better investment decisions and higher returns. One example of this is his decision to invest in Coca-Cola. When Buffett bought Coca-Cola in 1988, many people thought the company had already peaked. But Buffett understood the brand's strength, its loyal customer base, and its ability to generate consistent earnings. This is exactly what he looks for in every investment: companies with a strong competitive advantage in industries he knows. By focusing on his circle of competence, Buffett has been able to avoid investing in things he doesn't understand. This keeps him from making costly mistakes. His advice? Stay within your circle of competence and don't be afraid to say no to things that are outside it. Chapter 5. Compounding. The silent moneymaker. You're not using enough. Warren Buffett's wealth didn't come overnight. One of the biggest reasons for his success is his understanding of compounding. Compounding is the process where your money earns interest, and that interest earns even more interest. This is how small investments grow into huge amounts over time. Buffett once called compounding the eighth wonder of the world, saying, "He who understands it, earns it, he who doesn't, pays it." This is one of the core principles behind his strategy. The earlier you start investing, the more your money can compound over time. But compounding isn't just about starting early, it's also about being patient. Buffett's success didn't come from trying to time the market. Instead, he made smart, long-term investments that grew steadily. One of his most famous investments, in American Express, started in the 1960s and has continued to pay off for decades. Buffett's view of compounding can also be seen in his long-term holding strategy. He once said, "Our favorite holding period is forever." This shows his belief that the longer you hold an investment, the more you benefit from the magic of compounding. In fact, Buffett's annual return from Berkshire Hathaway has been around 20%, significantly higher than the average market return of 10%, thanks to compounding. Studies show that compounding is the key to growing wealth. A report by Charles Schwab found that someone who invests $10,000 at a 10% return for 30 years will end up with $174,494. That's the power of compounding. Buffett understood this early on, and it's been a huge factor in his success. Chapter 6. Learning from failures. Buffett's best losses that led to great wins. Warren Buffett's path to success wasn't always smooth. In fact, some of his best lessons came from his failures. Buffett often talks about how important it is to learn from mistakes, and he admits that he's made his fair share. But what sets him apart is his ability to learn from those losses and bounce back even stronger. One of Buffett's biggest mistakes was his investment in a company called Berkshire Hathaway, a textile business in the 1960s. At the time, Buffett bought shares in the company because he thought it was undervalued. However, the company's poor management and declining industry made it a bad investment. Despite this, Buffett learned from the experience and used it to shape his future investment decisions. Instead of dwelling on the loss, Buffett turned it into a valuable lesson. He said, "It's not whether you make mistakes, but how you react to them." From that point on, he became more focused on investing in companies with strong management and long-term growth potential. Buffett has also experienced other setbacks, like his initial reluctance to invest in technology stocks. But once he understood the value of companies like Apple, he made a bold move. Today, Apple is one of Berkshire Hathaway's most valuable holdings. This is another example of how Buffett's ability to adapt, learn, and take risks led to great success. Learning from failure is a crucial part of Buffett's strategy. He once said, "The best thing you can do is to keep learning and improving, no matter what." This mindset of using failures as stepping stones is what has kept Buffett at the top of his game for decades. By sticking to his circle of competence, harnessing the power of compounding, and learning from failures, Warren Buffett has built an empire. Each lesson has played a key role in shaping his career and helping him become one of the wealthiest investors in history. By applying these principles, anyone can become a smarter, more patient investor. Make sure to subscribe for more investment strategies that can change your financial future.